You saw the number, didn't you? 523% APY. It feels like a typo. In early 2022, a wild DeFi protocol called Mad Meerkat Finance, or MMF, was promising exactly that. It created a massive storm of excitement, with investors piling in to capture what looked like the opportunity of a lifetime. But what was really going on? Was that kind of yield even real? And more importantly, what happened to it? If you're wondering how a return like that was even possible, and what it can teach us today, you're in the right place. The story of MMF is more than a history lesson. It's a masterclass in how to navigate the tempting world of high-yield crypto without getting burned. In this video, I'm going to show you exactly how that 523% APY worked, step by step. Then, we'll pull back the curtain on the huge, often hidden risks that came with it. And finally, I'll give you a framework for spotting the difference between real opportunities and dangerous traps in today's market. This isn't just about MMF, it's about making you a smarter, safer DeFi investor. Staking MMF, a comprehensive guide to achieving 523% APY, intro and hook. Section 1, the case study. How did 523% APY even work? First, let's set the stage. Mad Meerkat Finance was an automated market maker, an AMM, and a decentralized exchange, or DEX, built on the Cronos blockchain. Think of it as the Uniswap or PancakeSwap for the Cronos world, which is closely tied to Crypto.com. At its peak, MMF was the king of the hill on Cronos, pulling in a ton of money and users. The platform had a bunch of ways to earn, from simple staking to complex yield farming. But those mind-blowing returns, the ones that looked like phone numbers, were almost always found in what are called liquidity pools, or LPs. So, how did you actually get a piece of that action? It was a multi-step dance that, while second nature to DeFi pros, could feel like rocket science to a newcomer. Let's walk through it. First, you had to get your money onto the Cronos chain. For most people, this meant buying the Cronos native token, CRO, on an exchange like Crypto.com. Then you'd send that CRO over to a personal DeFi wallet, like MetaMask or the Crypto.com DeFi wallet, that was set up for the Cronos network. This is the first rule of DeFi Club. You can't play in the decentralized world from a centralized account. Once your CRO landed in your wallet, you'd head to the MM Finance DApp, the decentralized application, using your wallet's browser. You'd connect your wallet, giving the platform permission to interact with your funds. Now for the secret sauce, that 523% APY wasn't for just holding MMF tokens, it was for providing liquidity. In DeFi, liquidity is the lifeblood that lets trading happen. You, the user, would provide a pair of tokens, like MMF and CRO, to a big pool. This allows other people to swap between those two tokens. For doing this, you'd earn a cut of the trading fees. To get that giant APY, you would first swap half of your CRO for MMF tokens on the MMF exchange itself. With an equal dollar value of both CRO and MMF, you'd go to the liquidity tab and deposit them together. In return, you got a special receipt token, called an LP token, proving you owned a piece of that MMF CRO pool. But wait, there's more. The final crucial step was to take those new LP tokens and stake them in a special farm. This is where the magic happened. By staking your LP tokens, you were earning not just trading fees but also a fire hose of extra rewards paid out in MMF tokens. It was the combination of trading fees plus the insane amount of newly printed MMF rewards that created that headline-grabbing APY. And to top it off, optimizer vaults on the platform would automatically reinvest your earnings for you, compounding your returns and pushing that advertised APY to unbelievable levels like 523% or even higher. Section 2. The catch, the dangers of chasing high APY. Okay, so the process was clear enough, but earning that 523% APY came with gigantic, often overlooked risks. Pay attention, because this is the part that separates successful DeFi investors from a horror story. The first and most brutal risk, token price volatility. That amazing APY is almost always paid in the platform's own token, which it can print more of. In this case, your 523% yield was a downpour of MMF tokens. So while you were racking up a mountain of MMF, the value of each one was on a roller coaster. And here's what happened in reality. The MMF token hit an all-time high of around 185 in April 2022. But as the crypto bear market took over and the initial hype died down, the price began to collapse. Today, MMF trades for just a tiny fraction of a cent, having lost over 99.9% of its value. That price crash completely vaporizes the APY. What good is earning 523% of a token if the token itself becomes nearly worthless? Your actual dollar return would be a catastrophic loss. This is the classic tale of inflationary farm tokens. The high APY comes from printing tokens, which creates massive selling pressure that crashes the price. The second huge risk, and one that trips up a lot of people, is impermanent loss. This danger is specific to being a liquidity provider with a token pair like our MMF CRO example. Put simply, impermanent loss is the difference in value between keeping your tokens in a liquidity pool versus just holding them separately in your wallet. When the price of one token in the pair, in this case, MMF, crashed, the pool's automatic rebalancing mechanism left liquidity providers holding a bag full of the now worthless MMF, having sold off their more valuable CRO along the way down. The loss is called impermanent because, in theory, if the token prices go back to their original ratio, the loss vanishes. But in a death spiral like MMF's, that loss becomes very, very permanent. Finally, there's smart contract and protocol risk. In May 2022, Finance was hit by a front-end exploit where attackers slipped a malicious contract into the website's code, draining about $2 million from users who were trying to make trades. While the core protocol itself wasn't hacked, it shows that you're exposed to risk at every level. To make matters worse, the project's development has largely stalled, and it was eventually delisted from the Crypto.com app in late 2024, signaling a loss of confidence from its main ecosystem partner.
Place where they told you what to chase, told you how to run the race. Every move was on the page, but I didn't like their way. Had to fight and misbehave.
So, what's the takeaway? Is all of DeFi a scam? Not at all. The story of Finance is a perfect case study of an older DeFi model that relied on printing tokens to create yields that were never built to last. The game has changed since then. The lesson isn't to run from DeFi, but to understand this. The advertised APY is meaningless if the underlying token is unstable. A high APY is a marketing gimmick. Your job is to look past it and ask the most important question: where does the yield really come from? Today, sustainable strategies are built on a different foundation. Instead of chasing crazy APYs from farm tokens, smart investors hunt for real yield. This is yield that comes from actual revenue, mostly from trading fees on popular assets. For instance, providing liquidity for a blue-chip pair like Ethereum and a stablecoin like USDC on a major exchange will get you a much lower APY, maybe 5–25%, but it's generated by real economic activity. Impermanent loss is still a factor, but the odds of Ethereum's price going to near zero like MMF's are astronomically lower. The modern DeFi world offers something for everyone. If you're conservative, you can lend out stablecoins like USDC on battle-tested platforms like Avi for returns that often beat traditional finance, but with far less price risk. If you want a bit more, you can use auto-compounding vaults on platforms like Yearn or Beefy Finance to farm those blue-chip pairs. They handle all the hard work of collecting and reinvesting your rewards for you. The gold rush for 500% APYs on unproven tokens is mostly over, and honestly, that's a good thing for the long-term health of crypto. The opportunity to earn real passive income is better than ever, but it demands a smarter, risk-first approach. Always diversify, never invest more than you can afford to lose, and focus on the source of the yield, not the flashy number on the billboard. So while you can't get 523% APY on MMF today, you can use the lessons from its spectacular rise and fall to build a stronger, smarter, and more sustainable DeFi portfolio. It's time to stop gambling and start investing. If you found this breakdown valuable and want to learn more about a modern DeFi strategy that's working right now, check out my video on concentrated liquidity. It's a deep dive into one of the smartest ways to earn real yield today. Thanks for watching. Remember to always do your own research, and I'll see you in the next one.